When it comes to building wealth through the stock market, investors often ask about selecting the right ETF. In 2025, two popular ETFs are SCHD and VOO, both from reputable providers. They offer efficient diversification. While they seem similar, they serve different investment philosophies. Your choice impacts wealth growth and return stability. VOO aims to replicate the S&P 500 index, covering 500 of the largest U.S. companies across various sectors. Investing in VOO means owning pieces of giants like Apple and Microsoft, linking your returns to major economic players. The S&P 500 historically averages a 10% annual return, which reflects market cycles and economic changes. SCHD focuses on dividend-paying stocks, targeting companies with a history of strong, consistent dividend growth. Managed by Charles Schwab, SCHD holds around 100 companies that pay dividends and have strong fundamentals. The index filters for companies with at least 10 years of dividend payments and sustainable payout ratios. SCHD enhances wealth growth not only through stock price appreciation, but also through dividends. In 2025, we're facing a different economic climate. Factors like high interest rates and inflation affect performance. The real question is which fund builds wealth faster, given the current market conditions. The S&P 500 often trades at higher price-to-earnings ratios compared to dividend-focused funds. SCHD screens for companies with solid fundamentals. In times of stretched markets, SCHD may provide better risk-adjusted returns. For investors worried about paying too much for growth, SCHD offers a disciplined approach. Expense ratios can significantly impact long-term compounding. VOO has an expense ratio of about 0.03%. SCHD is at 0.06%. Both are low-cost options, but the lower costs of VOO give it a microscopic edge over decades. SCHD offers a dividend yield of 3% to 3.5%, while VOO's hovers around 1.5%. Over decades, this can lead to significant reinvestment gains. For retirees or those seeking income, SCHD provides a built-in paycheck, while VOO requires selling shares for cash flow. One of the psychological advantages of SCHD is that investors feel rewarded even during flat or down markets. When stock prices aren't climbing, dividends still arrive, softening the emotional blow of volatility. With VOO, patience is required because the returns are tied directly to the broader market's performance. If wealth is purely about maximizing net worth over decades, VOO might have the edge in high-growth environments. If wealth is seen as growth, income, and peace of mind, SCHD builds practical wealth faster. Imagine two investors, Alex and Jordan, each starting in 2025 with $100,000. Alex chooses VOO while Jordan chooses SCHD. After 20 years, if VOO delivers 9% annually and SCHD delivers 8%, Alex ends up with more in raw numbers. However, Jordan's wealth grows more smoothly, enjoying steady cash flow if dividends are taken as income. For younger investors, VOO may be the better play in 2025. Maximizing growth makes sense, and VOO provides the cleanest exposure to U.S. large caps. For retirees or those approaching retirement, SCHD is compelling, The yield provides income, and the companies are relatively stable. The debate between SCHD and VOO is about aligning with your financial goals. Both funds are efficient, reliable, and low-cost options. 2025 will test both growth and dividend strategies. Whether you choose VOO or SCHD, you're giving yourself exposure to America's corporate backbone. Holding VOO for growth while pairing it with SCHD creates a balanced portfolio that can weather economic cycles, offering the best of both worlds. Volatility isn't necessarily bad for long-term investors who understand compounding. For younger investors, it can create opportunities to buy more shares at cheaper prices. Historically, every downturn in the S&P 500 has been followed by a recovery, and those who stayed invested came out wealthier. Selling out due to fear at the wrong time has destroyed more wealth. SCHD offers a psychological edge. Dividends roll in during downturns. This difference affects real-world wealth building, since discipline and patience often matter more than theoretical returns. VOO is market cap weighted with technology dominating. If tech stagnates, that could hurt VOO investors. SCHD is more diversified across sectors. CHD spreads risk differently, which can help smooth returns when one sector falls out of favor. Imagine an investor holding SCHD who collects a 3.5% dividend yield in 2025. If they choose to reinvest, that yield means more shares purchased automatically every quarter. Over 20 or 30 years, this snowball effect can rival or even surpass the growth you'd see in a pure growth ETF. Academic research shows reinvested dividends often account for more than half of long-term returns. CHD's appeal isn't just about the current income, but about the compounding machine it creates quietly in the background. VOO's lower yield means you rely more on capital appreciation for wealth growth. This changes the nature of how your portfolio compounds. Tax efficiency is crucial. VOO is highly tax efficient due to minimal turnover, while SCHD distributes higher dividends, which can be taxed. For investors minimizing tax bills in 2025, this difference may tilt the scale slightly in favor of VOO. Some don't mind taxes on dividends for the reward. In a world where inflation lingers, dividend stocks act as a hedge. Companies that raise dividends can pass rising costs on to consumers. CHD's focus on dividend growers gives it an edge with companies that have pricing power, invaluable if inflation remains sticky in 2025. VOO includes a range of companies, and not all can raise prices as effectively. However, large-cap tech companies do maintain pricing power. The cushion provided by SCHD's dividends adds resilience against inflation for investors. Investors in 2025 seek diversification beyond U.S. large caps, using both VOO and CHD as foundational building blocks. The choice between SCHD and VOO is about determining their roles in your broader financial plan, often complementing each other. Together, VOO gives exposure to growth, while SCHD offers consistent cash flow, creating a balanced portfolio for any scenario. Wealth building isn't just about maximizing the number on your account statement. It's about aligning your investments with your goals. Someone in their 20s or 30s might prioritize raw growth and lean heavily into VOO. In their 50s or 60s, they might value income and stability from SCHD. The beauty of the modern ETF landscape is you don't have to choose just one path. You can combine them in ratios that match your unique needs. In 2025, if interest rates remain elevated, high dividend funds like SCHD could face headwinds as investors compare yields against risk-free treasury yields. If rates begin to fall, dividend ETFs often become more attractive. VOO's performance will be affected by corporate earnings and economic policies. Owning VOO requires a long-term mindset, the willingness to hold through downturns, and the patience to let compounding do its work. Owning SCHD also requires patience, but the psychological reinforcement of regular dividends helps many investors stick with it. Staying the course is often more important than picking the absolute best performing fund. Both SCHD and VOO have their place in a disciplined, diversified portfolio. It doesn't have to be all or nothing. Many successful investors use a core and satellite approach, where VOO is the core and CHD enhances stability and income. This approach builds wealth through growth and consistency, crucial for generational wealth. An investor who panics and sells VOO during a downturn will never realize its full growth potential. An investor who spends all their SCHD dividends instead of reinvesting them might limit the compounding effect. Discipline, reinvestment, and long-term perspective matter just as much as which ticker symbol you choose. Both SCHD and VOO are powerful tools, but like any tool, they work best when used correctly. If you enjoyed it, don't forget to hit the like button, share it with your friends, and subscribe to the channel. Tap the notification bell so you'll be the first to know when a new video goes live. Thanks for watching.